£22.40. That's all that now stands between the full state pension and a tax bill. The pension is £12,547 a year. The tax-free allowance is £12,570, frozen, since 2021. So if you get the full state pension and any other income at all, a small works pension, a bit of savings interest, you are now a taxpayer. Nobody wrote to tell you. Nobody deducts it. The state pension is paid gross, no tax taken at source. It just sits there, quietly adding up, until the letter comes, with interest. And this year, HMRC signed a £175 million deal for a system built to find exactly this. I'll show you who it catches, how much it costs, and the one thing that decides whether this ends in a quiet correction or a formal inquiry. Now, how did we get here? Two numbers moved in opposite directions. The state pension goes up every year under the triple lock. This April, it rose 4.8%. The tax-free allowance does not move. It's been frozen at £12,570 since 2021, and it stays frozen until at least April 2028. Nobody voted for a pensioner tax. There was no announcement. One number simply climbed toward another, year after year, until the space between them was £22.40. That's what a freeze does. It raises tax without anyone having to say the word. And here's the part that matters most. The state pension is paid gross. No tax is taken off it, ever. So if you owe, nothing stops it. It just accumulates, quietly, until something surfaces it. Let me show you what that looks like at a kitchen table. Right now, this is being watched by a man in his late 60s. Worked 40-odd years, paid his national insurance every week without fail. Never once filled in a tax return. Never had to. He gets the full state pension. And on top of it, a small works pension from a job he left in the 90s. About £80 a month. That's it. That's his whole income. And that puts him just over the line. So let's do his sum out loud, because vague warnings help nobody. Full state pension, £12,548. His works pension, £960 a year. Total, £13,508. His allowance is £12,570. So £938 of that is taxable at 20%, £187. For the year, not ruinous on its own. But he doesn't know he owes it, so it didn't happen once. It's been happening every year, quietly, and nobody has matched it up yet. 3 years of that, plus interest, and it's a letter he didn't budget for. And why would he know? Nobody sat him down. His pension provider takes off what it can, but it cannot take tax off money it doesn't pay him. Meanwhile, HMRC already holds the data. His provider reports it. His bank reports his savings interest. It's all sitting there. It just hasn't been matched against the return, because there is no return. So let's be precise about who this touches. It isn't everyone. If the state pension is your only income, you pay nothing. You're £22 under. You're fine. But add any of these and you're over. A works pension of even a few hundred a year. Savings interest above your personal savings allowance. Dividends above £500. Rent, a part-time job. And let's put a number on that savings allowance, because the phrase means nothing on its own. If you're a basic rate taxpayer, you can earn £1,000 of interest a year, tax-free, on top of everything else. At today's rates, that's roughly £20-odd thousand sitting in an ordinary account before the interest itself becomes taxable. A lot of people crossed that line in the last 2 years without noticing, because rates went up and their balance never moved, and your bank reports every penny of that interest to HMRC automatically. It always has. Now, the important bit. It isn't a percentage of the excess. Once you're over the line, that income is taxed at 20% from the first pound. And one thing that catches people on the older basic state pension, the pre-2016 one, that's lower, so you have more headroom. But the same trap applies the moment your total crosses 12,570. It's the total that matters, not which pension it came from. So add it all up, every source. Now, I can hear the worry already. Does this mean I have to start filling in tax returns at 73? For most of you, no. And this is the part almost nobody explains. There's a second system, much quieter than self-assessment, called simple assessment. HMRC uses it when it already holds everything it needs. Your state pension figure from the DWP, your private pension from the provider, your savings interest from the bank. It doesn't ask you for anything. It arrives as a letter, Form PA302, with the calculation already done, telling you what you owe and when to pay. They go out mostly in July and August after the tax year ends. So if one is coming for last year, it's arriving about now. No return, no forms. You check it and you pay it. But, and this matters, check it. Don't just pay it. These figures come from third parties, and third parties make mistakes. The commonest one, joint savings accounts. Banks sometimes report the whole year's interest against one name, instead of splitting it 50-50 between a couple. That single error can push someone over the line who was never over it. Also check the state pension figure is what you actually received. The letter shows a full 52 weeks entitlement, which isn't always what landed in your account, especially in the year you started drawing it. If something's wrong, you have 60 days to tell them. Not 30, 60. And you can't request a simple assessment. HMRC decides each year whether you get one. Full self-assessment only comes into it if your affairs are more complicated. Untaxed savings and investment income over £10,000, self-employment, foreign income, that sort of thing. So for a pensioner with a pension, a bit of interest and nothing exotic, it's a letter, a check, and a payment. That's the whole thing. And stay with me, because at the end, I'm going to tell you the single thing that decides whether this becomes a quiet correction that costs you almost nothing or a formal inquiry that drags on for months. It's one choice, and it's entirely yours. That part alone is worth staying for. But right now, do one thing. If your mum or dad or a neighbor is on the state pension with a bit of something on top, send them this today. Because the people this catches hardest are exactly the people who've never been inside the system and don't know they need to be. Now, that's pensions. But the same thing is happening across everything else you might earn. And this one started quietly 2 years ago. Since January 2024, every major platform has been legally required to collect your details and report your income straight to HMRC. Airbnb, eBay, Vinted, Etsy, Amazon, Uber, the lot. The first report landed at HMRC in January 2025, covering the whole of 2024. The second landed in January 2026. They didn't investigate anyone. They didn't have to ask. The platforms just sent it. Now, before anyone panics about that jumper they sold on Vinted, there's a flaw, and you should know it. If you sell goods, the platform doesn't have to report you at all unless you cross both lines in the calendar year. 30 or more sales and about £1,700. Under both, you're not on the report. Clearing out a wardrobe isn't trading, and selling your own things second-hand for less than you paid isn't taxable income. It never was. But note the word goods. For services, Airbnb, driving, delivery, freelancing, there is no floor at all. One £400 Airbnb booking is enough to put you on the report. And here's what most sellers don't realize. The platform reports your gross income, everything the buyer paid before fees came off. You might declare what actually landed in your account. Honest, but different. And the difference is what flags. The first £1,000 a year is covered by the trading allowance. Under that, nothing to declare. Over it, it goes on a return. One more that catches people every single year. Rent-a-room relief. £7,500, tax-free, only applies to letting a room in the home you live in. A separate flat. A holiday let. A property you inherited from a parent. None of that qualifies. That's ordinary rental income, all of it, from the first pound. If you've earned through any platform and you're not certain your figures match theirs, every one of them lets you download your full payout history. Do that before HMRC does the comparing for you. If you let property, this next one changed your life in April, whether anyone told you or not. From the 6th of April, 2026, if your gross income from property or self-employment was over £50,000, you are in Making Tax Digital. HMRC reckons about 780,000 people are. That means digital records in approved software. 4 quarterly updates a year, the 7th of August, November, February and May. Then a final declaration. Think about what that changes. Before April, HMRC saw your income once a year. Now they see it 5 times. And each one is compared against your bank records, your letting agent's figures, the land registry, at the moment you submitted. A tenant paying 2 months up front, moved into the wrong quarter out of habit, isn't fraud. It's a timing error. But to a system cross-referencing bank data against quarterly submissions, it looks like a gap that needs explaining. Note the word gross. 50,000 is rent received, not profit. 4,500 a month in rent puts you in scope, even if what you actually keep is a fraction of that. Year 1 is a soft landing. No penalty points for late quarterly updates, but that ends. From 2027, 4 missed deadlines is a £200 fine, and another £200 for every one after that. And the soft landing never covered the final declaration. One more thing, the threshold drops. 30,000 from April 2027, 20,000 from April 2028. So if you're watching this thinking, I'm well under 50, check the date you'll be pulled in. And if you hold shares outside an ISA, 2 things moved against you at once this April. The dividend tax rate went up. Basic rate from 8.75% to 10.75%. Higher rate from 33.75 to 35.75. And the tax-free dividend allowance stayed at £500, which sounds small, because it is. In 2017, it was 5,000, cut by 90% in 9 years, while the rate on what's left went up. On £7,500 of taxable dividends, that rate change alone costs about £150 more this year than last. But the bigger risk isn't the rate, it's the trigger. If your total dividend income passes £10,000 in a tax year, you are required to register for self-assessment, whether or not you have ever filed anything in your life. And there's a date on that. If you needed to register for a tax year, the deadline is the 5th of October, after that year ends. Miss it, and there's a separate penalty for failure to notify, before you've paid a penny of the tax itself. And brokers report dividend data to HMRC directly. They know what you received. One relief, dividends inside an ISA or a pension are completely untouched by all of this. It's only what sits outside the wrapper. Now put those 4 things side by side, because separately, they're just rules. Together, there's something else. Platform income flowing in automatically since January 2025. Quarterly landlord data since April. Dividend data direct from brokers. Pension and savings data that was always there. More information about more people arriving more often than at any point in the history of British taxation. But data on its own is just storage. It becomes a letter when something is reading it. In May this year, HMRC signed a 10-year deal worth £175 million with a British artificial intelligence company to join every one of those sources into a single, connected picture of you as a taxpayer. The old system largely compared you against yourself, your return against your bank. The new one is built to compare everything at once, across years. Add 5,500 new compliance officers over 5 years, and a tax gap the government puts at £46.8 billion. The direction is not subtle. Now, I want to be fair about what this does and doesn't mean. These systems make mistakes. A letter on your doormat is not an accusation of anything criminal. It means a machine found a discrepancy and someone wants it explained. But explaining takes time. And it takes a toll, even when the answer turns out to be completely innocent. So what does this actually look like when it reaches you? Because it usually doesn't start with an inquiry. It starts with something much smaller. And how you handle that small thing decides everything that follows. It's called a nudge letter. Short, polite. 2 or 3 paragraphs. It says, HMRC has information suggesting you may have income you haven't declared and asks you to check your records and come back to them. No accusation, no figure demanded. Often, it doesn't even say what triggered it. And people do one of 3 things with it. Some panic, ring up in a fluster, and agree to something they haven't checked. Some, most honestly, put it behind the clock on the mantelpiece and hope. And some sit down, check their records properly, and reply. Only the third one ends well. Because ignoring it doesn't make it go away. It escalates it. The nudge is HMRC's cheap option. If it gets no answer, the next stage is a formal compliance check. And a formal check has a far wider scope than the question you were originally asked. They stop looking at the one thing. They look at everything. These letters typically suggest around 30 days to respond. Even if you're not ready with a full answer, reply inside that window and say you're gathering your records. A response buys you time. Silence doesn't. And one thing worth saying plainly, because it is absolutely the season for it. Scammers copy these letters. A real HMRC letter never demands payment by phone, never asks for your bank card details, never threatens arrest in the next hour. If a letter or a call feels like pressure, stop and ring HMRC yourself on the number from the gov.uk website, not the number on the letter. So, the thing I asked you to stay for. And it isn't a trick or a loophole. It's a percentage. When there's tax you didn't pay, HMRC charges a penalty on top. And the size of that penalty depends almost entirely on one thing. Who spoke first? If the mistake was careless rather than deliberate, which covers almost everybody watching this, and you come forward before HMRC contacts you, that's an unprompted disclosure. And the penalty can be reduced all the way down to nothing. 0%. You pay the tax you owed and the interest, and that is the end of it. But if HMRC contacts you first, and only then you disclose, that's prompted. And now the very same careless mistake carries a penalty that cannot go below 15% and runs up to 30%. And if HMRC decides the omission was deliberate rather than careless, you're in a different range entirely, up to 70%. And they can look back many more years than they otherwise could. Same money, same mistake. The difference between nothing and 30% is simply who picked up the phone first. That is the entire reason I've spent 20 minutes on this, not to frighten you, because right now, today, that choice is still yours to make. Once the envelope lands on the mat, it isn't. So, 4 checks. Slowly. 1. Add up every source of income you have. State pension, private pension, savings interest, dividends, rent, part-time work. If the total is over 12,570 and you're not in self-assessment or holding a simple assessment letter, you need to sort that. 2. If you've earned through Airbnb, eBay, Etsy, Vinted or similar, download your payout statements for 2024 and 2025 and compare them line by line against what you declared. 3. If your gross rental or self-employment income was over $50,000 in the 2024 to 25 tax year, confirm you are actually registered for Making Tax Digital. Not being in the system is itself a flag. 4. If your dividends pass £10,000, register and file. Don't sit on it. And if something is wrong, a small matter can be corrected through your online account. Anything significant, take it to an accountant. Don't try to be clever with it. And don't ignore it. £22.40. That's the gap. And the triple lock will close it. Not in a decade, in a couple of years, at which point the full state pension on its own is taxable, and this stops being about people with a bit on the side. Nothing here is criminal. For almost everybody, it's a gap between what HMRC could see and what was declared, widening quietly because nobody was told. What changed this year is that the system closing those gaps got faster, better fed, and far more powerful. What hasn't changed is that it deals better with people who come forward than with people it finds. So check your total this week, or check it for someone who won't check it for themselves. Look after yourselves. Figures are HMRC's and the DWP's own for the 2026 to 27 tax year. Scotland has different income tax bands. What you owe depends on your circumstances. This is general information, not advice. Citizens' advice, and for anything pension-related, the government's own PensionWise service will both help you, free of charge.